Okay, well, you're ready at 6:30. Whenever 6:30 can start. They got
Okay.
a cable running.
Okay, my clock says 6:29. As soon as it just turned to 6:30. Okay, Town of Southbridge public hearing on tax classification. A public hearing will be held by the Town Council on Monday, November 30th, 2020 at 6:30 p.m. by remote access only. Please refer to the town's website page for remote participation information and login. This public hearing will be held pursuant to Chapter 40, Section 56 on the adoption of a residential factor for tax purposes and the adoption of percentages of the local tax levy to be borne by each class of real and personal property. Any person wishing to speak will be given the opportunity to be heard. So, Jack, I'm sorry, Councillor Jovan, I don't see the record button on mine. Are you able to start the recording on this? Or do you need to? I'm not sure.
Yeah, let me just. Cable's recording it, but
This
I started
conference will now be recorded.
And if you could, just for the record, Will, after you're done reading, if you could just have Mary run the roll of the councils that are present.
Okay, well, I just read the public hearing. Mary, would you read the roll? I don't know if you need to do that language as well as far as the remote access. I don't have that on the copy that I have.
Okay, I can read it. Hold on 1 second. Pursuant to Governor Baker's March 12, 2020 order suspending certain provisions of the Open Meeting Law, General Law, Chapter 30A, Section 18, and the Governor's March 15, 2020 order imposing strict limitations on the number of people that may gather in one place, this public hearing of the Town Council is being conducted via remote participation only. No in-person attendance of members of the public will be permitted, but every effort will be made to ensure that the public can adequately access the proceedings as provided for in the order. Reminded that persons who would like to view this meeting while in progress may do so by watching Southbridge Cable Access Channel 192 and by the remote information noted below. We'll post a record of this meeting on the town's website at www.ci.southbridge.ma.us as soon as we are able to. And Mary, if you could just roll in the call of councilors present.
Sure. Councillor Adams?
Present.
Councillor Catrona?
Present.
Councillor Daniel?
Present.
Councillor Dow?
He's going to be delayed.
Councillor Jovan?
Present.
Councillor Lazo?
Present.
Councillor Marquetti?
Present.
Councillor Ryan? Oops. I see her. Councillor Ryan, can you hear me? Councillor Steves?
Present.
Great.
Okay, so let me begin. So this classification hearing is to present the information on the tax rate and the various options available under classification. It's a public hearing that has to be had in every city and town on adopting local classification factor and have been advised of the same. So I'm just going to go over some of the major points. So if anybody doesn't know them in the public. So this year, the total town value of the town after all of the valuation updates that the Board of Assessors has done is $1,193,256,447. And how that compares is we have to revalue all of the properties every year in town. And so the residential class and the commercial industrial classes to identify how much of the share of that tax burden they're currently paying versus comparable years. So this year, based on all of that value, the residential class is going to pay is valued at 78.5% of that total, and the commercial, industrial, and the personal property classes at 21.5%. And that's fairly consistent with last year. Last year, the residential class paid 78.3%. So this year, the tax levy, this is all the appropriations that the council voted, all the other state, local charges, after all of the other revenue sources, including state aid and all of the others, is $23,196,905. That's a 5.7% increase in the levy over last year. Our new growth is $445,036. So after the new growth, that's still a change of $816,526, or 3.2%. Bear with me a moment. So, I'm sorry, give me a second. So under Prop 2.5, a community can increase their levy as long as they're under the levy limit, which is what Proposition 2.5 outlines. This year, our levy limit is $23,635,621. That is, as I said before a moment ago, the actual tax levy is $23,196,905. I know these numbers can be, kind of difficult to fathom, but this year we are going to be $438,716 under our levy limit, which means we meet Proposition 2.5. We could have actually raised, if we needed to, an additional $438,716. So let's see. And so the town has various options under the classification law. We can adopt a residential exemption is one of the options. And what that does is the town could pass a residential exemption, which allows up to a 35% discount on the average residential value to owner-occupied residential properties. Gets a little confusing. So if the town were to adopt that, the tax rate actually increases from where it is for all residential properties. But then owner-occupied properties, depending on the percentage, if adopted, get a discount in the value. So the tax rate goes up, but they get a discount in the value, and their taxes are adjusted based on that. What it really does, it shifts the burden from the higher valued homes to the lower valued homes. And non-residential homes get taxed at a higher amount as well, such as second homes and apartment buildings and condos and so forth. As you know, Southbridge doesn't have a lot of second homes, so it's really not all that, it's not targeted very well to us. But so all residential land is taxed at the higher rate. It's not owner occupied, so they don't get that exemption because nobody lives there. This works in communities with a large amount of vacation homes or non-occupied properties to shift the burden onto. This year, the Board of Assessors strongly recommends against adoption of this exemption. The next option that we have is actually shifting the tax rate to the commercial, industrial, and personal property classes. So we've calculated based on everything, there will be, if there's a single tax rate this year, it would be $19.44 per $1,000 valuation on the residential and the commercial. Just for reference, last year was $19.48, so it went down slightly. But so the average single family property, average single family home under that one single tax rate would be taxed at, that tax would be $4,174. The average commercial value with a single tax rate would be $10,994, and the average industrial under a single tax rate would be $11,965. The important thing to remember is if you shift the tax rate, because of the proportion of residential to commercial, industrial, and personal property, every 1 cent off the residential tax rate adds 3.5 cents to the commercial because it's far less. If you recall earlier, I said 78.3% residential, and the balance is commercial. For every dollar saved residential class off the tax rate, 3.5. I'm sorry, for every penny saved off the residential tax rate, 3.5 cents goes to the commercial industrial. So those are my comments for this, and I'd invite any residents who would like to speak on this. Please feel free.
Is that somebody out there? Do you wish to speak on the tax rate, man? You're muted, I believe. Anyone? I'm not sure if that woman wished to speak.
It looks like she's frozen.
Yeah, it does. Yep. Any counselors wish to discuss with Will? Ma'am, are you back? I'm not sure if she's here. Council Marquetti?
Thank you, Councilor Joanne. Mr. Chair, I was just wondering, how do you come up with these assessed values for the different property classifications?
Through the chair, we use standard appraisal methodology of when it comes to the residential class, we have to use the arm's length sales in the prior year. We have to revalue every property every year based on those sales, and as of January 1 prior to the fiscal year. So for the fiscal year we're in right now, all of our property values are as of January 1. So in the resident, we're required to use two approaches to value: the market or sales approach, which is what I said, using the comp. And we also back that up with the cost approach. So I believe in the single family class, we had 103 arm's length sales. So we have to do ratio study of property through our modeling. If our assessed value is, for example, $200,000 and it sells for $220,000, we have to use that comp. In other words, adjust the modeling on that sale property to make it equal a full and fair cash value, for example, $220,000 in that case. And we have to do that on all of the market sales. Then you have to submit that to the Department of Revenue, and they use statistical analysis in the off years and full audits in the revaluation year, like last year, where they come out, look at the houses, look at the houses that sold, look at our assessments, make sure the models are correct. And by using this ratio analysis, we have to comply with ratio assessment standards. So in other words, we have to have an assessment to sales ratio of 90 to 100%. We pick what we want at the level of assessment. We usually pick 95 because in that market, you want to be pretty close. So all of our sales have to be, all of our sale properties have to be, our assessments have to be at that 95, that assessment sales ratio, the median assessment sales ratio. And then the Department of Revenue further has standards of what's called, I don't want to get into too much statistics, but your variation from the median cannot be more than a certain amount, which is pretty precise. So that's how we generally come up with it. Then this Department of Revenue measures it by neighborhood, by price quartiles by the quarters of the year, neighborhoods, by style, by age, by a couple of other breakdowns that you have to do. But it's pretty precise. And what that all means is they're at full and fair cash value. When it comes to income producing properties like apartment buildings and commercial industrial property, you don't get as many sales. You do get some, but you don't get as many. So in addition to what I just said there, we also have to use what's called the income approach to value. So every year we have to send out income and expense questionnaires to all of the apartment buildings, all of the businesses, to find out what certain size buildings are renting for, what apartments are renting for, what stores are renting for, what warehouses are renting for. So we get all that income, and also we use all of the appraisal journals and the published numbers as well. So based on that income, you're able to estimate or project what the income, the net operating income of any of those buildings is going to be. Then you capitalize that income the same as an investor would, and that yields whatever the value is. And again, on the same end, the Department of Revenue audits all of our numbers every 5 years, but we still have to hold to the standards in the interim years. And we do that every year, revalue those numbers. These numbers are all submitted to the Department of Revenue for their review and approval. They're approved this year. And that's how we get our numbers. And that's just a quick version. It's actually much more in depth.
So a 4-unit apartment building that I was looking, I like to watch the Sunday paper for the real estate sales. And there was a 4-unit plus apartment complex on Worcester Street that you assessed at $654,000, but it sold for $2.25 million. So you were a little off on the assessment value of that property, unless it doesn't work that way. Or does that mean that it won't take effect till next year? How exactly does that work?
Well, so there's a few things that let me break it down for you. So for the assessed values that we have right now, those are all calendar year 2019 sales. And the date of valuation is January 1, 2020. It's December of 2020 right now. So the date of valuation is a year old on what we have right now. And the sales are 2 years old for what we have right now. And these according to exactly what the Department of Revenue requires. The specific example that you said right there, I'd have to look at that. That doesn't make any sense. A 4-unit apartment building selling for, I forget what you said, $1 million or $2 million. That just doesn't happen. There must be something else going on there.
Well, there isn't. I mean, I looked at your assessed value of the property and I compared it to the sale price of the property, and it was they sold it for $2.25. You assessed it at the whole property. There were actually 2 buildings and some vacant land, and it was assessed at $654,000. But I'm just not sure how that works. If it doesn't take effect until 2 years from now, if that's the case, then you're basing the value of our homes on sales from 2 years ago?
That's correct. All of the assessed values are as of January 1, 2020. That's correct. And that's the law from Southbridge to Boston to Pittsfield. That's what is required.
But commercial properties are not based on sales?
They are based on sales, but we don't have the number of sales. So you use the income approach to value.
And that's the income for what they pay for rent. It's not based on how much they make as a commercial enterprise.
No, you separate the enterprise away from that. It's based on what that building would generate in a net operating income. So, for example, if you had a 6-family house and you had $1,000 a month, so what's that? 12 times 6, $72,000 a year. That would be the gross rent. From that, you subtract all of the expenses and so forth, and that would yield an income of, let's perhaps $30,000 a year in net operating income. You take that $30,000 and you capitalize that by a capitalization rate, and let's just pretend for the capitalization was 10%. So if you had a $30,000 net operating income for that building, and the capitalization rate is 10%, you divide that, that yields a value of $300,000. That's a simplistic explanation of the income approach. And that's how investors buy buildings. It's based on what the NOI is, net operating income, and the cap rates at the time.
All right, thank you.
Can I have a question? Hi.
Hi,
Yeah.
I'll be glad to answer it. Sure. What can I do for you?
Yes, I have a question related to what you was explaining about residential exemption and chapter. You had different options. One was residential exception, 35%, and then you say something about chipping to the tax rate to commercial. Can you explain a little more about that?
Yes, I'd be happy to. So
Well, before you answer, I think for the record, she has to state her name and her address because it is a public hearing, I believe.
My name is Evelyn Velez, and I live in 26 Denison Cross Road.
Thank you.
Thank you. So the residential exemption is, as I said, a town can pass it, and what it does is it allows this exemption in value of. It gets kind of complicated. I don't want to do that, but it gives an exemption in value. For example, if the average town residential property was $200,000, and you can go up to 35%, like I said, but I'm going to use the example of 10% because it's a lot simpler in the math. So if the average residential value was $200,000 and the town passed a 10% residential exemption, so that would mean if the owner-occupied properties would take $20,000 off of their assessed value, okay? But by law, the residential class has to make up the same amount of tax dollars as it did before this exemption was granted. So what happens is the tax rate on the residential side, as I said, with a single tax rate this year, it'll be $19.44. If a residential exemption was passed, that tax rate would go up. I'm not going to speculate what the number would be, but it would be over $20, probably $21. Okay. So what happens is the lower valued properties get that value exemption taken off, but then they get multiplied by the higher tax rate, and the lower valued properties would save a little bit of money. The medium priced properties would break even, owner-occupied properties. The higher priced owner-occupied properties would pay more in dollars. The non-owner occupied properties would pay considerably more in dollars because they're not getting that value exemption taken off. So this exemption is used in the places like a Martha's Vineyard, Nantucket, cities and towns around Boston, and some of the Cape Cod communities. I believe there's 14 cities and towns that have it. In my experience, I'm explaining it because it's available. It makes little to no sense for Southbridge because, again, we don't have any residential, we don't have any second homes here, like they do on Nantucket, for example. So getting back to the shifting of the tax rate. So the shifting of the tax rate says you're allowed to shift the tax rate from the residential to the commercial, industrial, and personal property classes, all the way up from 1% all the way up to 50%. If you do that, the commercial, industrial, personal property classes of property pay more, the residential pays less. But because of the mix of residential to commercial mix that we have, again, every dollar off the residential tax rate goes $3.50. I believe that's the right number, $3.50 to the commercial class. So it really, to save I'm not going to say it's relatively small, to save the $1, it costs quite a bit to the commercial industrial class. So that's the two of them.
Okay, thank you. Can you tell me when was the last time that we raised taxes in Southbridge?
Last year, pretty much inevitably they go up a little to a middle amount every year. About 12, 13, 14 years ago, they went up a lot. Last year was the last time.
So if this is the 2.5, the 2.5 proposal, that's what they are talking in this meeting?
Well, Proposition 2.5 rules over all of this. And what it says is, it doesn't say you can't raise taxes more than 2.5%. What it says is a town has what's called a levy limit, which is the amount that they can, maximum amount they can raise every year. And so that levy limit, according to the state law, says that can be increased by 2.5% plus any new growth in your community, so, which we have. But many communities are at their levy limit every year. We're not. We're below our levy limit. So we could raise it all the way up to that levy limit. And that gives us a little more flexibility. But so that's what the Prop 2.5 says.
Okay, so the councilors are going to be voting tonight, making a decision. They're going to be raising the taxes. Is this
No.
what this meeting is about, or just the proposed?
No, the council isn't voting to raise the taxes. With all of the events that have already happened in the entire course of the year, that leads to the things I'm going to be talking about now and presenting later. The tax levy is what I said it was going to be here. And that's based on the budgets that were voted back in May of last year and all the projected state aid. It's exactly where we thought it was going to be a year ago. What the town council is going to vote on is this. They're going to vote whether they want to have that residential exemption and whether they want to shift the tax rate.
Okay, so that is the decision tonight. It's not about, okay. Thank you.
You're welcome.
Anyone else? Are there any other citizens that wish to address on this public hearing? Any other citizens? Any other councilors?
Oh, sorry. Councilor Steves, forgive me.
Councilor Adams.
Yeah, a couple of quick questions. First off, earlier you mentioned, Mike, okay. You mentioned the 103 arm's length sale. I assume those are houses. How many CIP sales did we actually see this year? Not many, but
Not many. It was either 3 or 4. I can look it up.
4?
There's just one thing I'd like to make clear. The apartment buildings, over 4-unit apartment buildings, we had 11 of those, I believe, and they're right on with the assessed values to the sale prices. But the commercial industry and the apartment buildings are part of the residential class. A lot of times people think they're commercial.
Yeah, we've talked about that before, and that's something I know. I think me and Councilor Marchetti and a few others have raised concerns that they probably should be commercial, but unfortunately, legally, they're not. That's a legislative issue. One of the things I was curious about is there any way to identify how many of the arm's length sales resulted in corporations or outside investors buying homes here in town, as opposed to sales to actual people who live here?
No, there isn't. But one of the things about arm's length sales is this. So the Department of Revenue is very, very careful about, and so am I, about arm's length sales. For it to be an arm's length sales, it has to be exposed to the market. In other words, listed on the MLS or some type of forum like that. If family sales, even if it's listed, that doesn't count. If it's sold to a butter, that doesn't count. If it's sold to a liquidator, we really take a look at it. So in other words, it really has. So an arm's length sales is clearly an arm's length sales. Now, to answer your question about whether it's an investor or something like that, in the apartment building category, I would say quite a few of them are. Not many people buy an 8-unit apartment building to live in it, although some do. But the way I typically look at it is I look to see where the bills are being mailed to. And that gives me a good idea.
Okay. And I was curious. I get feedback from someone. And also in the report that you sent to us in the packet, you mentioned that you talk about the increases primarily due to improvement in the overall condition of residential real estate market. And I was curious, how is that defined? By whose definition has the market improved under what circumstances? Because I know there's a lot of people in our community who are I've seen a lot. Let me rephrase that. I've seen a lot of houses in our community sit on the market for an extended period of time. Sometimes they bounce on and off the market. They don't sell. Several of them are on our street. And there's other issues with people being in situations where, especially with COVID-19 issues, possibly facing foreclosure in the next month or so, when the COVID money runs out. That's going to be a huge issue. Hopefully not here, but it could be. So could you explain that a little, how that's determined?
Well, the statement I make is, well, first of all, an appraisal is an opinion of value by an appraiser. I'm an appraiser, so I offer opinions of value, and they have to be backed up, of course, by the numbers. So the statement I made, that's an opinion. So, and I base that on, there's a very, very short supply of short supply of houses for sale. They get snapped up very, very quickly. The metrics of the MLS shows how many days on the market and so forth. Typically, from my experience, if a house isn't selling, it may be priced a little bit too high, because the market in the last 2 years to me has been nothing short of phenomenal. And I think most people who've sold a house would say the same thing. So it's an opinion of value based on some solid metrics, but it's still an opinion. And one of the things I see is what the rates of increase are, and through all of the real estate journals and MLS and so forth. But it's an opinion.
Okay, yeah, because I personally think that was why I was asking that, and why I had asked the previous question, is that I have a feeling a lot of this market is basically froth created by investors who sit on the properties, because we see so many buildings around town, even if they're not being sold, are half vacant. I can think of a couple on my street that have been they're not necessarily on the market, but nothing's happening either. So they don't look like they're occupied, and there's a whole bunch of houses that are on the market that aren't occupied. So I'm kind of concerned about that. How do those kinds of vacancies affect the market values, and is there any way of calculating or taking them out of the tax rate, or how they would affect the tax rate? I don't know if there is such a thing.
I can't tell you if they affect the tax rate, but I can tell you in the appraisals, if it's an arm's length sale, you have to use it. If it's not an arm's length sale, you don't. It's simply that much. When it comes to sale of properties, I visit most of them. In fact, I go with the fire inspector on a lot of them before they even sell, to take a look at them, to make sure the condition is correct, to find out if there's anything else going on in the market. And in the single family and two family, it's not really the investors. It's people buying the houses to live in. The investors come into it if there's a house that's distressed or in poor condition. Investors will look to buy it from a lending institution or somebody, a short sale or whatnot, and they're having a hard time buying those. I have them telling me they're paying far more money to buy these houses that need a lot of work than they ever did before. But the single families, I find it's people who want to live there, new homeowners and so forth.
Okay, thanks.
Anyone else? I don't check Councilor Jovan. I don't see anyone else. We'll be talking about this at the council meeting as well, and I'll be giving some additional information.
Okay,
Okay.
thank you.
If there's no one else, hearing no one else, we will close this public hearing at 7:03 p.m. and we'll move into the council, special town council meeting. Thank you, Will.
Thank you.